People always ask, how can I maximize my itemized deductions? Or if I take itemized deduction, am I disallowed to take my business deductions? Today, I'm going to answer those questions, and also I will tell you how you can maximize your itemized deduction, or I might even argue why you should not be taking itemized deduction and take standard deduction, even though your itemized deduction are higher than your standard deduction. I'm Ashish with Investor Friendly CPA, and I'm making these informal videos so that you guys can understand some basic tax concepts. And we'll also talk about more complicated ones. So let's talk about what are itemized deductions. Itemized deductions there are a list of this, let's say mostly 5 deductions that you can take that goes against your taxable income. Right? So when you file your taxes, you will see this form, you have all your income, and you'll see this is 2023 form, and you'll see either you can take standard deduction or itemized deduction. Everyone gets them. It's better if your deduction is higher. So standard deductions is one set number. If you're married, I think it is $27,000 for 2023. But itemized deduction, it can get higher than that, and you take the higher amount as itemized deduction. That's the concept. So what are itemized deduction? Let me just walk you through that, okay? It's the medical expenses, taxes, local and state taxes you pay, mortgage interest and other investment interest, sometimes charity, and other things that mostly doesn't apply to everyone, but those are the basic ones. When you itemize, when these expenses are higher than your standard deductions, you get to take these higher amount. So as I was saying before, a lot of people have questions, what happens to all my business expenses if I take standard deduction versus itemized deduction? Because my itemized deductions are lower than my standard deduction, can I deduct all my business expense? Yes, you can. It has nothing to do with everything we're talking about today has nothing to do with your business deduction. You can always itemize them and deduct them at the business level. We're not talking about them, okay? So you either take itemized deduction or standard deduction. You take standard deduction if your itemized deduction is lower than your itemized deduction. So you take standard deduction if your itemized deductions, these things we just talked about, are lower than your standard deduction. So let me walk you through this. When do you take itemized deduction? When you have more medical expenses, when you own a house, primary residence, or a second house, and you have real estate taxes and mortgage interest payment for your residence, then you get itemized deduction might be higher than standard deduction. You might have some gambling losses, or you might have contributed to the charity. These are the things that drive itemized deduction, and it can get higher than the standard deduction, which is $27,000 for married filing jointly. Remember, everyone gets $27,000. You only benefit from itemized deduction if this expenses gets higher than that standard deduction. So what people do is they try to increase their itemized deduction and to go up. What I'm going to argue in the next few minutes is maybe you should not. And we'll talk about that, how that works, okay? So let me go quickly through what are these expenses. Medical expenses, anything. If it's not reimbursed by your insurance and the co-pays and hospital care, doctors and drugs, everything you pay is medical expenses. Sometimes your insurance expense as a self-employed can count towards this, but you would rather deduct that at the business level. But we'll talk about that in the next few minutes, okay? That medical expenses, property taxes and state and local income tax. I didn't put income tax here, but property tax and state and local and local taxes that you pay to the state also counts towards the taxes. Now remember, taxes are limited to $10,000. It was a new rule a couple of years ago. So no matter if you pay $100,000 to state as an income tax and even property tax, you still get limited to $10,000. We're going to talk about how to get around that in the next few minutes. Mortgage interest. We talked about it. If you own a primary residence or second house, vacation house, not a rental property, okay? It's a second house or primary residence, you can deduct mortgage interest from that property. You can only deduct the interest up to $750,000 of the debt, okay, on the new properties. There's no longer interest deduction for a HELOC, a home equity line of credit, going forward. So that's the mortgage interest. And last one that I want to touch upon is charity. If you give money to charity, you can deduct those, right? So all of these make sense. But there's some issues. Some of the issues while taking itemized deductions are medical expenses. The expenses needs to be above 7.5% of your adjusted gross income, AGI. So most people cannot take the medical expense deduction. Tax deductions we talked about, it's capped at 10K, meaning if you pay $50,000 to state and you also pay $12,000 as a property tax to your county, you only can take $10,000. You cannot take entire $70K. So you're limited. And sometimes investment interest deduction is also limited to investment income. And we talked about HELOC interest do not count. and your loan is capped at $750,000, right? All of those things makes it challenging for people to get maximum from these expenses. So what I'm going to argue is, can you basically double dip? Meaning, this is what I mean. Remember, you either get to take standard deduction or itemized deduction. If you just take standard deduction, which everyone gets, and convert some of these expenses that we're talking about to business expense or other areas, how to get around this 10K limitation, maybe you can deduct more. So let's talk about how to do that, okay? First is, can you deduct medical expense at the business level? There are a lot of arrangement, HRA and other type of arrangement you can make at the business level, which can reimburse you for the medical expenses. Remember, you can never deduct a medical expense because, so most of the time, because it has to be more than 7.5% of your AGI. However, if you put the expenses at the business level, you get to deduct that. So you get to deduct medical expenses at the business level without any limitation. That's the first one. Second one is taxes. There's a few ways to get around this tax limitation of 10K. First one is called PTE tax elections. Most of the state now allows you to pay state taxes at the business level as a business expense so that it's not limited at the individual level. You get to deduct that at the business level because there's no limitation. Okay, that's what the PTE tax election for your business means. So if possible, if your business is making income, you need to look into this tax election. There are some states that allows you to get tax credit if you fund their education fund, scholarship fund, or even charitable fund. If you fund that, you get to deduct that as a charitable donation rather than taxes. Charitable donations are not limited at 10K, such as the taxes are. Okay, so you might want to look into those kind of credits. The other tools, remember, you also get to deduct some of the taxes to pay to your auto. Let's say you renew your registration and you pay a yearly, tax on your auto. You can deduct that if you use the vehicle for your business, right? If you don't use it for a business, then it falls on your individual and it gets capped at the individual at 10K, which you're not even allowed to deduct your income tax and property tax. Tax for the auto really doesn't come into play. So if you transfer the activity to business, you can deduct it. The other one is same thing with the real estate taxes. If you use your house and if you have, let's say you have a 5-room house and you use 2 of them for home office, one for you and one for your spouse, then you can deduct taxes at the business level. And not only taxes, insurances, repairs, which is personal in nature, can be deducted. But we're not going there right now. We're just talking about taxes, which is limited at itemized deduction, right? So those are, first one is medical, second one is taxes, third one is investment interest deduction. Remember, if you are limited for investment interest, you can take more investment income like interest. You can have an arrangement where you give out loans to your friends and families or, stocks and stuff. You just need to gather more investment income to deduct investment interest. That's how you get around the investment interest. Mortgage interest, let's talk about this. How do you get around the cap that you have for mortgage interest? First of all, if you use your home, again, you use your home as a home office, there's no limitation on mortgage interest. That's the first one, right? Because you can deduct the interest at the home office level, and the remaining amount that's not home office, you can deduct it at the itemized deduction level. So you get around that $750,000 cap. The second one is this, and this is a much better way. You take out the loan. You pay off the loan that you have in your primary residence. You pay off entire loan, and then you take the HELOC out, home equity line of credit, basically another loan. Use that money to do something else. Let's say you go and buy a rental property, or use that for a business or other investment. Doesn't matter. You can deduct that interest at those business level, which is never limited. Okay. So I'm hoping this makes sense, because our goal is to not even take itemized deduction. If you can just take the HELOC out and transfer entire interest expense to other business activities, you don't need itemized deduction. You get that almost $29,000 for 2023 or 2024 anyway, that everyone gets without a primary residence or anything. Take that and convert all of your personal expenses into business expense so you can deduct them at the business level. It's like double dipping. And I'll show you math in the next few minutes. The last one I want to talk about is charity. Convert your charitable donations into business expense. And this is what IRS says. If you give money to charity and expect for you to make some money from them, like to further your business, or they invite you to speak at the event, if you're giving charity not just to give charity and move on, but to expect some kind of market exposure, then you can deduct them as advertisement. Okay, there are multiple court cases which have supported this. So if you donate to charity to get into a new market and they invite you and you have a lunch or a table and you speak, that's an advertisement. That's not charity, and it's not limited. Same thing with, let's say you say 5% of my sales goes to charity. Again, it's not a charitable donation deduction, it's a business expense. It's not a charity. So you can convert some of your charity, let's say you have a good heart and you want to give out, but it's not saving you taxes. Maybe you should reconsider your strategy where you can actually look into these charities and convert them to business expense. Okay? Now, everything I just said converts to your business expense. Mortgage interest is converted to your business expense. Same thing with this, PTE taxes, medical expense, right? Everything converts to business. So why am I saying that is this? Let me explain this. Itemized deduction, remember these two buckets, okay? You either take itemized deduction or standard deduction. When do you take itemized deduction? You take when it's greater than your standard deduction. In 2024, it's around $29,000. So let's say your itemized deduction is around $35,000. Then you take this, you would save 30, let's say your tax rate, your marginal tax rate is 35, then you save $12,000. Very simple, right? But you lost this 29, you're not double dipping this, you're not taking this again. What I'm saying is take the standard deduction, right? And then convert some of this $35,000 to business, not all of them. So there's some of them to business expense, and also take this deduction. So at the both level, if you look at this, you're saving $10,000 from standard deduction, and you're also saving another, or almost $9,000 from standard business deduction. So in combined, that's $19,000 versus $12,000 tax savings. So I know it's a lot of information. Hopefully this makes sense. Talk to your tax advisor if you don't understand this. Reach out if you need any help. We are posting more and more educational content, so follow us and you'll see us again. Thank you.